Hey everybody, this is David Skarika. So what we're gonna do, this is our kind of extended stock chart of the day that we do on the weekend. So what we're gonna do here is we're gonna talk about we saw this big rally in the market. I've been talking about seasonality. I've been cutting back on my shorts basically right before it happened. I probably left them one day too long because I wanted to see the reaction to the Fed meeting. I should have just stuck to my discipline of covering in October. Um, and I've said before, like the seasonality of November, December is not for stocks to really go down. Actually, I think going into an election year, especially usually that November to May time frame is very, very positive. So I'm just going to show you some charts of the markets. I also have been talking about the potential for interest rates topping in the short term here, which looks like it's going to happen. So we're going to sit here and look at everything here. One second. Okay, so we're looking at well, that's Aurora Cannabis. That's a stock we were talking about in my members section. But anyhow, we're gonna go look at the stock market here. So here you can see that the S&P and Dow have these, we're still kind of in the downtrend, but if we break about 440 on the spiders, which is like 4,400 on the S&P roughly, it does look like we're probably going to see a year-end rally. And, this is why, like, basically I've shorted kind of in August, September, and then I kind of was getting out here in October. And it doesn't always work. Like, okay, it's great in 1987 or 1929 or 1937. You can get those huge meltdowns in the market and make a killing, or sometimes you just get corrections or small type things. So that looks like what's happening to me. And again, seasonally, we are in this strong period for stocks. And like I said, like if we break this, and you can see the same thing. We'll look at the diamond, same thing on the Dow. The Dow is actually right there, basically at its high of the last rally. Of course, the Dow did lag on the way down. So maybe it's kind of outperforming now. But same thing on the NASDAQ QQQs here. You can kind of see we're still barely in this downtrend. But again, if we kind of break this 370 area, which is another day like today, we'll basically do it and really start 375, which again is only like 2% from here. It does look to me like we'll probably go higher. And if we go look, one thing I talked about in my members thing is we go look at the 1966 to 1968 bull market in stocks. Yeah. So this is like the small bear market that happened in 66. And you can see here the market went down. Actually, it was similar as 9 months. It was like 25%, just like the one we just saw last year in 2022. And then the market to 1968 went to 108. So, that would kind of like be the market going to like 5,200 or something on the S&P. So it wasn't a huge bull market. And then the market fell over 35% into 1970. And then there was another rally into 73. And then the market fell again, of course, 73, 74 bear market. So that's kind of what I'm looking at here. And actually that mid 60s area, this was when inflation started to tick up. I think inflation got up to like 5-6% in the mid 60s and then fell back down to 2-3. And that was part of the reason you had this rally. And then we had the first really big surge in inflation in that kind of like, 69, 70 bear market. So that's kind of what I'm looking at here if we are in a bear market. But again, I go look at the seasonality. I know this is the time of year when things usually pick up, et cetera, et cetera. Now there are a lot of like disconcerting things. Like, I don't know if these transports are going back to these highs, right? But maybe if the Dow, S&P, NASDAQ hit new highs, the transport don't, that's a non-confirmation and a sell signal. But those on the Dow theory, but that takes a while for the market to play out. So again, another thing I want to talk about, is interest rates. Even though I know a lot of people think I'm a perma bear and I'm a gold bug, but I'm really not. And I've been calling for the top in interest rates. And remember, I was much more hawkish than most people were. I was saying, look, this inflation problem is worse than people think. And the Fed is going to raise rates. Remember, even back when the Fed started, people still thought rates were only going to go to like 2%, like they did in 2018. And I was like, no. The setup here is it really looks like the rates are going to go to whatever, 3, 4, 5% on the short end. And that's what's happened, So we can see December, 95% chance they stand pat. No, it's really they're going to do nothing now. This has collapsed since the last Fed meeting. At one point, the January meeting was almost like 60-40 that they would do like a 40% chance they would raise one more time. Now that's basically done. You can see, then the rate cut scenarios actually start coming in March. By May, we've actually got over a 50% chance of a rate cut. And, that's not huge. By the middle of next year, we're basically at like a 70% or 75% chance that rates are down half a point, and about a 35% chance they're down 3/4. So that isn't huge, especially when we've raised over 500 basis points. But it does look like to me that these stocks, like, or the bonds, you can see the bond here is kind of broken for the first time in months and months and months, broke its broke a short-term high, right? Hit a new short-term high. So yeah, I think that and like I've said, interest rate cycles are very long. This interest rate bull market or bond bull market was 1981 to 2020. So it was nearly 40 years. The bear market, or so the bull market in bonds, or bear market in bonds before that, was like the late 40s to 1981. So it was like, again, longer than 30 years. So these bond cycles tend to be 30 to 40 years. They're extremely wrong. They're longer than even stock cycles tend to be 10 to 20 years. So it's almost like you get two stock cycles in one bond market cycle. So I think we're in that. But again, if you go from zero, if we go look at the 10-year bond here, if you go from zero till about 5%, right? There's, we're going to go look at a really long-term so I can show you what the bonds did during the bull market, right? We're going back to November 1980. And you can see it was like, bonds were 15% there, but look, they would go down, then they would go up, and they'd go down and up. So there would be like 2 steps down, 1 step back up on interest rates. So now it looks like you can see we've taken out all this resistance for the first time in over 40 years. We've hit new highs. We don't have the lower lows and lower highs in interest rates anymore. And but there's no reason, like, I don't know, maybe you go back down to 3%, right? 3.5%. You go boom, boom, or even 2.5%. You go 2 steps up, 1 step back, on the downside. I do think that, and one reason we're seeing this being so much quicker off the bottom, part of the reason is the bottom was zero, but part of the reason I think is the debt is so much higher. It's not the 1950s where the US was a creditor. We were coming out of World War II, where the economy was booming, unemployment was low. People did not have their own consumer debt. The government debt to GDP was shrinking because, you didn't have that spending from the war anymore. Now we're seeing the opposite. Government debt to GDP is increasing, or it's north of 100%. All the estimates show that, by 2040, 2050, it's going to be like the highest level ever. It's going to be 200% of GDP. I don't think it might not ever get there, because I think we'll have a debt crisis before that happens. But anyhow, but again, nothing's going to go straight up. But I do think after this next rally in the bond, so if you still have a mortgage, I would lock in on this rally because I think that's the last time, if that bond does go to 3%, that's the last time you're going to see that for a long time. So anyhow, I just wanted to do this extended stock chart of the day. I wanted to show you, interest rates look like short-term bottom. There's really no chance of a Fed rate hike anymore. We've seen a rally in the bond, declines in rates. We're in the seasonal strong period for stocks. Even if stocks were to go lower, it would be a very choppy lower. So I just say chill out for Thanksgiving and Christmas. We'll talk about maybe gold and precious metals a little more in next week's extended update. But gold is sitting right on 2000 on the futures. It just looks like to me like we're out of that, and my paying service, I've kind of shifted to more a couple value longs that I've been talking about for a while. 2 I was stopped out of earlier in the year. Now I think they're really cheap. And 1 had really good earnings. You can see it up there on the screen the whole time. It was Fubo. Might as well talk about it. Fubo was up nearly 10% on its earnings. So I'm feeling pretty good because I got out of most of my shorts and the market popped. Even individual shorts. I'd put options on 1 stock that the day before earnings, I sold it, the last of the puts, and then they went up 14% on earnings. So I was happy not to be short anymore. So everybody take care. Like you all. Have a great weekend. I'm able to do this in the middle of the night because, daylight savings time gave me that extra hour of sleep, which is always nice. I guess I'm not really using it to sleep. I'm using it to do this, but you know, what can you do?